Ever struggled with raising capital and finding the right investors and wondered why in the world you can't actually get any progress? Well, after dealing with literally over 100 investors in the last 30 to 45 days, I can tell you that one of the biggest challenges that most companies have when it comes to raising capital is that they are not talking to the right investors. You see, in the process of raising capital, one of the crucial first steps is to identify who the right investor is. Not everybody is a good fit for every deal. Just because somebody has millions or billions of dollars available does not mean they're going to invest in every single deal. In fact, a lot of investors have a very, very specific way that they evaluate deals and a very specific type of deal that they look at because of that. And so as a result, they are not willing to go outside of that box and invest in just anything. So whenever a company comes to us and they start asking us, well, what would it take for me to go raise capital? We have to figure out a few things. First, we have to figure out what the long-term vision is for the company. What is the exit strategy? In a lot of cases, a founder or a capital raiser has no idea what the exit strategy is. They're like, I just need to get the deal done. If I get the deal done, I'll figure that out later because once I have the money, I have the time to figure that all out. And that's not what investors want to hear. What they want to hear is, how am I going to get my money back? Not just, hopefully get it back, but definitely get it back. And if I can make more on the back end, that's great. But I'll tell you, somebody who's going to invest in a real estate deal is completely different from somebody who's going to invest in a potential unicorn startup that doesn't have any revenue yet. One person probably wants safety and security and stability, knowing that there's a real asset behind it with potential cash flow every single month and maybe some appreciation over the long haul, versus somebody else who's willing to put in $25,000 to $100,000 or more into a company that's completely untested and unproven, and they're betting on a 100x upside in the future. Why are those two people different? Well, you think about the person who's going to put money into a real estate deal. They want that consistent, reliable, stable cash flow. A person that's willing to put money into an angel investment at that pre-revenue stage especially is really just almost making a donation. It's kind of like a gamble in a certain sense. They know that there's a really high likelihood they're going to lose their money. And so they don't need the money. Versus maybe somebody who's working on a fixed income or using their retirement funds to invest in a deal, they need that income. So they're very different people. But then you talk about, okay, the people that are willing to invest in startups across the board, there's also different types of startup investors. There's your venture capitalists that might be looking at early stage or seed stage investments, and they have a very specific thesis. Maybe they will invest in oil and gas. Well, guess what? An oil and gas investor is probably not also going to invest in solar farms, right? Again, different investor profiles. And if you do not know what the right investor profile is because you haven't spent the time to figure out what your long-term vision and exit strategy is, you're going to miss the mark. Okay? Once you figured out what the exit strategy is and you figured out what kind of returns an investor might get as a result of investing in you, you need to then identify who are the right people. Now, we already talked about this a little bit, but if you don't know what kind of returns you're going to offer, then you don't know what kind of investor to go after. And let's just face it, a lot of people are not willing to take risk when they do investments. This is why they put their money into stocks, bonds, mutual funds, and their own real estate in their own business. They have a little bit more control over their own real estate in their own business. And stocks, bonds, and mutual funds traditionally are less risky than, say, startups or oil field exploration or the next AI technology that's coming out. So you need to understand what the risk appetite is for these investors that you're going to go approach. And then once you figured out the risk appetite, you can finally hone in on where are they? Do they need to have $5 million liquidity to invest in your deal and feel safe about it? Or is it somebody that says, hey, listen, I can put $25,000 in, and is that going to move the needle for you? Okay, so understanding those components is really important before you even go out there and start talking to investors. Otherwise, you're going to be banging your head against the wall and climbing up the wrong ladder, only to be really disappointed in the end and having wasted a lot of time and energy.